Hey there, quick mental image. You're at a concert. Everyone's having a great time. Music's loud, lights are flashing, and then someone yells, "Exit, now!" What happens? Nobody calmly walks out in single file. People rush. People push. People trip. The exits don't get bigger just because everyone wants to leave. Now replace the concert with the stock market. And the exit with the sell button. That's where things get interesting. Meet Alice. Alice owns some stocks. She's been investing for a while. Most days, she doesn't think about it. But one morning, she opens her phone and the news is screaming. Markets plunge. Historic sell-off. Worst day in years. Her portfolio is down. Not a little. A lot. Alice feels that tight feeling in her chest. She thinks, maybe I should sell before it gets worse. At the exact same moment, millions of other Alices are thinking the same thing. This is the part nobody explains clearly. Markets don't move because people want to sell. They move because people actually do sell. And selling requires one very important thing: a buyer. Every sale needs someone on the other side. Someone willing to say, sure, I'll take that. Now here's the problem. When everyone tries to sell at once, buyers disappear. Why? Because fear spreads faster than logic. If prices are falling, buyers wait. If I wait, I might get it cheaper. So they step back. That creates a vacuum. Lots of sellers, very few buyers. Prices don't gently decline. They drop hard. Not because companies suddenly became worthless, but because the market is a matching system and the match is broke. Think of it like a garage sale. If one person is selling a bike, they can find a buyer. If everyone on the street tries to sell bikes at the same time, prices collapse. Someone eventually buys, but only at a huge discount. That's what happens in markets. Liquidity dries up. Liquidity is just a fancy word for can I sell without blowing everything up? In calm times, yes. In panic times, nope. Now let's bring in Bob. Bob is watching the same news, same headlines, same red numbers. But Bob notices something different. Trading volume is exploding. Prices are jumping, not stepping. That tells Bob something important. This isn't careful selling. This is forced selling. People aren't calmly rebalancing. They're trying to escape. Now here's the brutal truth. When everyone sells at once, price stops meaning value. Price becomes desperation. People don't ask, what is this worth? They ask, who will take this off my hands? That's when markets overshoot. Downward. Assets get cheaper than they should be. Not because reality changed overnight, but because emotion took over the steering wheel. Alice sees her portfolio drop even more. She thinks this is proof I was right to panic. So she sells. And that selling pushes prices lower, which scares the next person. And the next. This is how a sell-off turns into a crash. Not because everyone agreed on a new value, but because everyone tried to exit a narrow door at the same time. Now, here's something that sounds obvious, but people forget it constantly. Markets are not designed for everyone to leave at once. They're designed for a mix. Some buyers, some sellers, balance. When balance breaks, prices gap. Now let's talk about something extra spicy. Leverage. Some people borrowed money to invest. Margin loans. Debt. When prices fall too far, brokers don't ask politely. They force sales. Automatic selling. No emotion. No patience. Just math. This adds fuel to the fire. Prices drop. Forced selling kicks in. Prices drop more. That's how small declines turn into avalanches. Alice didn't borrow, but she's still affected because forced sellers don't care who else gets hurt. They just sell. Now here's where the system steps in. Exchanges halt trading. Circuit breakers. Pauses. Not because they want to control prices, but because humans need time. Time to breathe. Time to process. Time for buyers to come back. Because without pauses, panic feeds on itself. Now let's zoom out. What happens after everyone tries to sell? Eventually, someone buys. Someone always does. Because prices eventually fall far enough to attract buyers with patience and cash, that's when Bob shows up. Not at the first dip, not at the second, but when selling feels exhausting, When headlines feel apocalyptic. When Alice says, I can't watch this anymore. Bob doesn't buy because he's fearless. He buys because the imbalance flipped. Too many sellers. Not enough buyers. Prices fell faster than value. Now here's the uncomfortable part. Bob can only buy because he didn't need to sell. He wasn't forced. He had liquidity. This is why crashes punish fragility and reward resilience. Now let's be very clear. When everyone tries to sell at once, most people lose. Even people who sell early often sell lower than they expected. Because there is no clean exit. The exit gets crowded immediately. The idea of I'll just sell before everyone else works only in theory. In reality, by the time you feel the urge to sell, millions already do. That's why timing crashes is so hard. Now let's talk about the emotional aftermath. Alice sold. She feels relief. The pain stopped. But then markets stabilize. Prices stop falling. Then slowly, they rise. Alice feels regret. She thinks, I sold at the worst time. Bob thinks that was the transfer. This cycle repeats over and over across history. Different assets, same behavior. Now here's the key idea I want you to sit with. Markets don't collapse because assets are bad. They collapse because coordination fails. Everyone acts individually, but the outcome is collective. Everyone selling makes selling work. Everyone waiting to buy makes buying more powerful later. This is why markets feel cruel. They punish crowd behavior and reward doing the opposite. But doing the opposite feels wrong in the moment. Fear is convincing. Now pause. Does this mean never sell? No. It means understand what selling during panic actually does. It means understanding that liquidity is not guaranteed. And that I can always get out is only true when others aren't trying to do the same thing. Because the market is not a vending machine. It's a crowd. And crowds don't behave politely under stress. So when Alice asks what happens if everyone tries to sell at once, the answer isn't abstract. It's very human. Prices collapse. Liquidity vanishes. Fear feeds fear. And the people who survive that moment aren't the fastest. They're the ones who didn't need to run. And that raises a much deeper question. If selling together makes things worse and holding through panic feels impossible, then the real risk isn't the market itself. It's what happens when your personal situation forces you to act at the worst possible moment. And that's where the story really starts to shift. Because the real danger isn't the market falling. It's you being forced to react while it's falling. Alice didn't sell because she was stupid. She sold because uncertainty feels threatening. And uncertainty plus urgency is a powerful combo. This is why personal finance matters more than market predictions. If Alice had a strong emergency fund, stable income, and no urgent need for cash, that red screen would still hurt, but it wouldn't command her. She could choose. Choice is everything in a panic. Bob understands this. He doesn't just prepare for crashes emotionally. He prepares structurally. He keeps liquidity not to time the market, but to avoid being timed by the market. That's the difference. Now let's talk about something markets never advertise. Liquidity is not evenly distributed. In good times, it looks like everyone has it. You can sell instantly. Spreads are tight. Everything feels smooth. In bad times, liquidity hides. Market makers widen spreads. Buyers disappear. Prices jump instead of glide. That's why charts look violent during crashes. It's not because people suddenly disagree wildly. It's because the bridge between buyers and sellers shrinks. Now here's the part that feels unfair. Retail investors like Alice feel the worst of this. She sells into thin air. Institutions like Bob, they have tools. Block trades, private negotiations, better access. They can move size with less damage. Again, not because of intelligence, because of position. Now let's address a myth. Smart money always sells before the crash. No. Smart money prepares before the crash. Selling early sounds good in hindsight. In reality, it's almost impossible to do consistently. By the time warning signs are obvious, markets already moved. That's why most professionals don't try to dodge crashes perfectly. They try to survive them. Now let's talk about something that sounds boring but saves people. Diversification. When Alice owned only a few things, everything fell together. That made panic feel justified. When Bob owned many things, some fell less, some even rose. The picture was less dramatic. Less drama means fewer emotional decisions. Diversification doesn't prevent losses. It prevents desperation. Now let's zoom out one more time. What happens after everyone tries to sell at once? Eventually, selling slows. Not because fear disappears, but because sellers run out. Those who had to sell already did. That's when prices stabilize. That's when buyers step back in. That's when headlines quietly change tone. And that's when the recovery begins. Not with optimism, with exhaustion. People get tired of panicking. Now here's the cruel irony. The moment selling feels pointless is often the moment selling pressure is almost gone. But that moment feels awful, hopeless. That's why people miss it. Bob waits for that feeling. Not a signal, not a number, a mood. Because markets are human systems. They turn on emotion. Now here's something important. The market doesn't remember your pain. It doesn't care where you bought. It doesn't care where you sold. It just keeps moving. So Alice's job isn't to outsmart the market. It's to design her life so she doesn't have to make irreversible decisions during irreversible moments. That's the real lesson. Not never sell. Not always buy. But don't be forced. Because forced decisions are almost always bad decisions. Now let's tie this back to the original question. What happens if everyone tries to sell at once? Prices fall faster than logic. Liquidity vanishes. Fear compounds. But underneath all of that chaos, the system doesn't break forever. It bends. And then it resets. The people who suffer most aren't the ones who guessed wrong. They're the ones who lacked flexibility. That's why crashes feel like betrayals. People followed the rules but didn't realize the hidden rule. Markets punish rigidity. They reward optionality. Now let's be very honest. Most people can't become Bob overnight. And that's okay. This isn't about turning everyone into a crash profiteer. It's about reducing fragility, building buffers, avoiding over-leverage, accepting that volatility is the price of growth. So when the next panic comes, and it will, the goal isn't to feel fearless. It's to feel able to wait. Waiting is the superpower. Now let's land this. When Alice understands this, she stops asking, how do I sell faster? And starts asking, how do I make sure I'm not forced to sell? That single shift changes everything. So in conclusion, when everyone tries to sell at once, markets don't gently adjust. They break down temporarily. Buyers disappear, liquidity dries up, and prices collapse faster than value changes. Crashes aren't about assets becoming worthless. They're about too many people needing to exit at the same time. The people who survive and sometimes benefit are the ones who aren't forced to act under pressure. Resilience, liquidity, and patience matter more than speed. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.